Welcome to Straight Talk on Retirement, your no-hype source for financial advice and making informed choices about your retirement planning. Get on the phone to talk today at 314-931-5877 or text your question to 84126.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Now, here are your retirement coaches, Jeff and Aaron Lapidus.
Well, hello, St. Louis, and welcome to Straight Talk on Retirement. You're live and local, St. Louis's favorite financial call-in show. I'm Jeff Lapidus, president of JBL Financial Services. Our office is located in beautiful, chilly, downtown Olivet, Missouri. I'm a 42-year veteran of the financial services area, a fee-based financial planner and wealth manager. And I'm joined this week and every single week for our new extended 2-hour show with my favorite oldest prodigal daughter, Aaron Lapidus, who also is a fee-based financial planner and wealth manager.
And we help our clients make smart choices about their money. The way we do that is by designing a game plan, a written step-by-step strategy, a real game plan that has several goals in mind.
First is to preserve, protect, and prudently grow the assets our clients have taken their entire lifetimes to accumulate. Second is to deliver a reliable stream of income, one that they can count on, so they can do all the things they'd like to do during retirement.
And third is cost-effectively addressing their health care needs, like helping individuals enroll in Medicare and choosing the right plan to supplement their medical coverage.
And then when they're done enjoying their assets during their lifetime, we show them how to pass them on to the people they love, whether it's their spouses or children, grandchildren, churches, or charities, whoever it might be, with Uncle Sam or the tax courts taking a big bite out of their money. And as their wealth managers, Aaron and I watch their money every single day to make sure they're staying on track. And that's why they call us the retirement coaches. Babe, good morning.
Good morning.
Thank God it's morning out here. The sun just finally peeked out of the clouds.
Well, we are all just feeling so terrible for you out there in California.
Well, it's fun. And again, we do appreciate everybody.
Is it fun when it's more than 25 degrees?
I'm sure that it is. I'm a little better than that right now, but it's still pretty early for the old man. What can I tell you?
Well, here we are.
And that's right, and we're looking forward to having fun. This is our first Happy New Year, of course, and everybody. This is our first extended 2-hour show. We hope to be doing this for a long time with you due to popular demand and Aaron's insistence, as I like to say.
That's exactly what it was.
Exactly. So welcome again to the show. We'll be on from 9 to 11 every single Saturday here on the Big 550 KTRS. And we do want to remind everybody that all of our clients are folks that are like you. They're our listeners. They're 55 and older. They would like to retire or they're already retired. And what do we do, babe?
We help them design a game plan so they can do all the things that they'd like to do in retirement.
Exactly. And so before we get into our programming for the show today, we do want to remind everybody that we do have a website.
That's right.
jblfinancial.com. And we also have a monthly newsletter.
That's right. If you log on to our website, JBL, know that we were going to be here at 9 a.m. Also, a blog about healthcare, as well as our monthly newsletter, which you can access by clicking in the pop-up box that appears in the lower left-hand side of the screen. You click sign up, provide us with your email address, and we can send that out to you every month. Or if you just want to peruse some of our older newsletters, you can click on the Contact Us section, click on the Newsletter section, and you will see the last 12 months of our newsletters archived for you to download. If you'd like to print them or just read them off the computer, they're available to you. We haven't posted the January newsletter yet. However, I have it right here.
We'll go for it.
So the first article is a great one. It's an infographic again. We like to add these infographics to our first topic of every newsletter. big boost for Social Security payments. So this is in reference to the 5.9% COLA that was added for 2022 due to inflationary pressures that we've all been experiencing. The average monthly Social Security benefit for a retired worker after 2022 is $1,657 a month, which is a $92 increase per month. That's the average.
That's fabulous. So we know those gone up, but at the same time, so have the Medicare Part B premiums, right?
That's right. Medicare Part B premiums have increased. The nice thing is, well, if you can say it's nice, Medicare and Social Security have what's called a hold harmless agreement, which means if you are enrolled in Social Security and also taking your Medicare, the government has determined that Medicare cannot raise the premiums more than your Social Security increase that was provided. So that's why they were not able to raise the premium more than the $92 that the average Social Security recipient was receiving. Now, if you are an individual that's just taking Medicare and not on Social Security yet, you don't have that protection. However, this year there was not a differential between those already on both Social Security and Medicare and those just on Medicare.
Well, that's great. Again, that's our first article. What's the second, third, and fourth articles?
The second article, Are You Henry? And what is that acronym? High earner, not rich yet. So this is an article about basically the snapshot of the median net worth of U.S. families over the last several years. It also gives a few tips on how maybe you're a high-income earner, but you haven't necessarily amassed a large amount of money yet for retirement, or what you would feel comfortable for retirement. So it talks about, paying attention to your spending, not necessarily creating a budget, but just determining where the cash is actually going. Making sure that you're utilizing your retirement plan. So even if you're not the biggest fan of your 401k choices, or maybe you feel like the match isn't as lucrative as it should be with your employer, you still want to take advantage of those things, because that's still part, as I like to say, the match for your 401k or your 403b or your simple IRA, depending upon what you have through your employer, is part of your compensation. So if you're not maximizing the employer match, you're really missing out on part of what you're working for. Or some people like to call it the free money. It's extra money that your employer is adding to your retirement plan to help you get there faster.
That's fabulous, and a great article, good thinking points. And I was going to say article number 3 is one that I'll bet we're going to get a lot of questions about during this hour.
That's right. So the third article is annuity income. So this is discussing the different strategies for withdrawing money from an annuity contract. One is an annuitization versus a lifetime withdrawal. This is a great article because lifetime withdrawal benefits did not always exist inside of annuity contracts. So sometimes this is a new feature to discuss with your advisor, or if you haven't met with one yet and they're discussing potential annuities with you, this would be something that you'd like to bring up with them. What is your goal for this annuity contract? Do we plan to annuitize it over time, or do we plan to use lifetime withdrawal benefits, which can be available to you?
Yeah, and I really like this article because it very much highlights the difference between annuitization, which is really giving back the asset value to the insurance company in exchange for a lifetime income, which is really what a pension is, versus a withdrawal strategy. Again, the lifetime withdrawal strategy is a rider. It's one that you do pay an extra charge for. It's something that modifies the current contract. And it may actually be something that could work for you. Again, it's real important to discuss annuities and how they fit into your financial plan because, as I like to say, there's no good deals.
Right. It's all about what works for you. And I think this article is great because, one, it gives a nice description, but then also there's an infographic inside of this article as well that really highlights what annuitization means versus what a lifetime withdrawal means. So, for example, Dad, you just mentioned annuitization has no fees. That's a base part of every annuity contract. The lifetime withdrawal feature can have additional costs for the rider because this is something that you add to a base contract.
Very good. So again, we're certainly open to any questions folks have on this today, because most new contracts are issued, especially ones in IRAs, are usually issued with these features, and they do differ for different companies.
Right, and the costs can differ as well.
Now, the last article is kind of fun. If you don't drive a car, if you don't own a car, consider non-owner insurance.
So this is great for individuals who potentially have decided that maybe they're not driving as much as they were before, so what is the point of maintaining car insurance, upkeep on a vehicle, potentially car payments, gas, all of those things. Maybe you are living in a more metropolitan area. However, if you're someone that's using a car sharing service, so like you got to go pick up some groceries and you need a vehicle for that, or if you frequently drive rentals, this is a lower cost way to insure yourself as the driver.
Good article. Again, we do call it the Coach's Corner newsletter, easy to access. Just go to our website, jblfinancial.com. Click on that Coach's Corner newsletter icon at the bottom left side of the page, and we'll be very happy to send that to you every month by email. But there are a couple of other important things that they can do on our website, right, babe? Especially the Contact Us section.
That's right. In the upper right-hand corner of the screen, you can click the Contact Us button. Send us an email if you have a question, if you'd like to schedule a coaching session, if you'd like to see us for retirement planning, for Medicare planning. If you'd like to chat with us, just drop us a line. Those emails go directly to us, so we will respond within 24 hours.
Awesome. Well, great. And again, our phone lines are open. We would love to hear from you. Keep us awake this morning, 931-5877, star 5877 from your cell phones, or 84126 from the text line. And so, again, we're obviously going to take your calls as they come in. Again, we'd love to hear from you. Again, 314-931-5877, star 5877 from your cell phones, or 84126 from the text line. We're live and local. We'd love to hear from you. And I guess while we're waiting for your calls, babe, why don't we get into our first subject today? One I know that many folks are asking themselves that are out there.
Is this your year?
Right?
That's right. Is this your year?
And there are a lot of factors that come into making the decision about, is this your year? Firstly, question number one, just about everyone asks, other than, am I a rock star? We tell them that when they come in and visit with us, is, have I accumulated enough money to replace a portion of my paycheck? The second question really is, in most cases, am I willing and am I ready to give up my work? That is, my pay and the social relationships that usually go along with that. And really, what will I be doing to replace my time?
Sometimes
obviously, getting a second opinion about this is something that's extremely useful for you. In many cases, you can get clarity, and in most cases, you're getting confirmation of your thinking, right?
That's exactly right. And I also think that, some of these secondary questions can be more difficult to answer than the financial ones for individuals. What am I going to do in my retired time? Am I ready to give up, like you said, Dad, the social aspect of my position or even the responsibility of my position? A lot of individuals we find are possibly ready to retire from their career, but they still have, as you like to say, Dad, enough tread left on the tires that they would like to do something else in retirement, maybe a little lower pressure of a situation or, just less hours. So those are all things that you want to consider when you're thinking about, maybe, is this my year to retire?
Well, babe, I was going to say, I know that last week you visited with some folks, our good friends, Joe and Sally. Why don't we talk a little about them?
That's right. Joe is 55 and Sally is 53. They've worked for the same company since they graduated from college. You all know you all know this company. It's a large airplane manufacturer who moved their headquarters to Seattle. when we did their financial plan, we discovered that they had enough income from their pension and Social Security to cover their income needs, which was $8,000 per month. They had also accumulated a large amount inside of their retirement accounts, over $2 million. They also had money in their money market accounts, which was totaling about $90,000.
So they had a lot of capital, and they also had some very good liquidity.
That's right. They also had excellent potential for cash flow with their pensions, and we haven't even gotten to Social Security yet because they are so young.
Yeah, they are youngsters. And, when we're doing our analysis of folks' retirement income, we always like to start in the back end, which is to say when all the faucets are on, when we're taking Social Security benefits, when we're taking those pension benefits, if there are other income benefits, where are we at as compared to our current income? And we found out that, at normal retirement age, they were easy. But as you can imagine, they're kids. They're only in their mid-50s. So getting there was certainly a question and something that we also addressed.
Before we, you know what, Dad? Before we continue on with Joe and Sally, Ann has a retirement question on the line.
That's fabulous. Ann, good morning and welcome to the show.
Hi, thank you for taking my call. I'm going to be retiring soon. I work for the state of Illinois. So they have multiple options as to they have a buyout. Of course, they have your pension. And so I was wondering if you advise and set up times for advising people that are retiring from Illinois.
Absolutely we do, Ann, and this is perfect timing because we are actually going to be discussing something very similar to what the state of Illinois has offered you with our conversation about Joe and Sally. They have a pension option. They also have a buyout or a lump sum option available to them. So there are a few discussion points that we make sure to bring up with all potential clients or clients when we're discussing what makes the most sense in their retirement plan. Is it the pension or is it the lump sum or the buyout?
Right. Okay. Well, I will want to schedule a session with you.
We would love to see you, Ann. You can either log on to our website, jblfinancial.com, click in the Contact Us section, and just type us a quick email, give us some information so our office manager, Kelly, can reach out to you. Or you can send us an email, aaron@jblfinancial.com or jeff@jblfinancial.com.
Or just call the office and leave, just call the office, of course, and leave, at 314-863-0008. And if you like, leave a message, and we'll be happy to get back to you.
That's right, 314-863-0008.
Fabo, great way to break the ice in the show today, Ann. Thank you so much for calling.
Absolutely.
And, we don't talk about this often, and frankly, we don't really make reference to what side of the river the folks live, but I would say probably a third of our clients are over in the great state of Illinois, right?
Some of them as far south as Marion, Illinois. So,
which is wonderful, and you know about that a little better than I do.
I do. I've been blueberry picking down in the beautiful Shawnee Forest. So we like to work with, and we also work with individuals really all over the country. Many of them have really been originally based in St. Louis or Illinois, or Missouri or Illinois rather, and decided to take their retirement somewhere warmer, somewhere closer to the grandchildren. And we still like to follow our clients because either they often come back to St. Louis for a visit, or we've got the ability to work with individuals remotely through Zoom and telephone appointments, email conversations, phone conversations, things like that.
Yeah, well, it's fun to create these relationships and obviously to nurture them and maintain them over long periods of time. And that really gets us back to, our original topic while we're waiting for your calls at 314-931-5877, star 5877 from your cell phones, or 84126 from the usually busy chat line.
Well, you know what, Dad? Let's make everyone wait with a little bit more anticipation and take our first break of the hour. And when we get back, we'll continue talking about Joe and Sally, who think it might be their year to retire.
That's great. Well, I'm Jeff Lapidus, the retirement coach.
I'm Aaron Lapidus, the retirement coach.
Don't touch that dial. We'll be right back.
Hi, Frank Blair from Schnarr's Hardware here. Well, still no popcorn. but we have resumed our regular hours, and we're open for in-store shopping or curbside pickup. If all that stay-at-home cooking has your grill looking a little tired, we stock cleaning products and replacement parts for Weber and Big Green Egg grills. Or, if you're ready for a new one, come by and see us. We'll help you pick out the right one, assemble it, drop it off, and even haul away your old grill. And as always, we are here to help you get your projects around the house done. So put on your mask and come on in and we'll get you taken care of. If you prefer no-contact shopping, call us with your list for same-day curbside pickup. You can also go to our website, schnars.com, and order online to arrive at our store in a few days. Call us at 314-993-0910 in Ladue and 314-961-4522 in Webster. Schnars Hardware, where the popcorn has taken a break. And we hope it will be back very soon. Stay safe and God bless.
Individual rates, coverage offerings, and savings may vary, subject to terms and conditions. Not available in all areas. Small businesses are the backbone of America. Yet when it comes to workers' comp insurance, you rarely get the savings you deserve. That's because insurance companies tend to lump you in with other businesses, and you can get overcharged. At Pi Insurance, we're on a mission to change that. With Pi, you get a quote specific to your business, and you could save up to 30% with no hassle and no hidden fees. If you like savings, take 3 minutes to see how much you could save at trypi.com. Pi makes workers' comp insurance as easy as pie, with friendly representatives just a call away. No wonder customers rate our service excellent on Trustpilot. You work hard to build your business and keep your employees safe. You deserve more from your workers' comp provider. See how much you could save with Pi Insurance. Ask your agent for Pi or get a quote today at trypi.com. That's trypie.com.
Hi, Charlie. Daddy's home.
Yeah.
I missed you too. Hey, time to get you groomed.
No.
Come on, Charlie. I'm taking you to a new groomer, Pet Bar Boutique. They do grooming, ear cleaning, nail trims, and more. And Pet Bar Boutique has self and full-service bath and brush, too.
Yes.
Keep your best friend clean and happy at the new state-of-the-art Pet Bar Boutique. Locally owned and operated on Manchester, just east of 270. Book online at petbarinc.com.
Now is when Coventry turns confusion into clarity. Coventry Healthcare has got a simple approach to care. By listening to their members, Coventry can make plans that work harder for you and your budget. The result? They offer great service and clear costs. If you're looking for a plan that's more about you, give them a call at 1-855-338-9551, 8 a.m. to 8 p.m. That's 1-855-338-9551. Now is the time to call Coventry Healthcare.
If you're turning 65 this year, you face one of the most critical choices for your retirement game plan: enrolling in Medicare Part B and choosing your Medicare supplement. I will help you safely navigate this process and find the health insurance plan that best works with your new Medicare coverage. Getting started is easy. Call me at 314-863-0008, 314-863-0008 to arrange for a free health insurance coaching session, or email me at erin@jblfinancial.com. This is Erin Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email at erin@jblfinancial.com to arrange your free coaching session. Let's get started on your retirement game plan today.
Now back to Straight Talk and Retirement on the Big 550 KTRS. Here's Jeff and Erin Lapidus.
Back on the Big 550 KTRS, Talk Radio St. Louis. I'm Jeff Lapidus, the retirement coach.
And I'm Erin Lapidus, the retirement coach.
And we're here to answer your questions at 314-931-5877, star 5877 for your cell phones, or 84126 from the hot text line. Well, it's nice to be back. It's actually nice to take a break for once, right?
Have a moment to collect your thoughts about Joe and Sally. They've been the listeners have been waiting to hear if it's their year to retire.
Well, and Joe and Sally, obviously, they're in a good place financially, as we discussed. They have a large retirement accounts, about $2 million. They've got liquidity that they've saved some money back, about 90,000 money market accounts. But sometimes it's not about the money. In Joe's case, he's recently been promoted at this large airplane manufacturer who moved their headquarters to Seattle, and he's looking forward to his new responsibilities and higher pay.
That's right.
But Sally's in a different place, though, right?
That's right. Sally is ready to retire because she is looking to have more grandma time. She already has 2 grandchildren and one on the way.
Well, great for Joe and Sally.
It is really very, very nice for Joe and Sally. We really want to be able to make sure we can help Sally spend as much time as she can with those 2, soon to be 3 grandchildren.
There you go. And there's nothing more sacred than grandma time, as your mom would tell me, etc. So, their youngest son also is about to start his first year of college. So they've got some financial obligations, and they've got some other things, at least for Joe, that's kind of holding him back. So what's the holdup? What do you think?
Well, we got a few things. We talked about how very young Sally happens to be, and she's young for a couple of reasons. First is you need to be 59 and a half in order to access your pension, access her 401k plan or IRAs if she happened to have them directly. Also, there may be restrictions or reductions in her pension depending upon her age and what their pension plan says. Sally's also 10 years too young for Social Security.
Yes, she is. And, they've also mentioned to us that they prefer not to borrow money to help finance their son's tuition costs, which is why they put aside this large amount of money in a money market account. So after our discussion, after looking at the back end, the end point, they thought, we really want to make this happen for Sally. So what are some suggestions that we made to them to consider?
So many people might be thinking right now, oh, well, Sally can just pull money out of that 401k because of the special rule that they have. But unfortunately, you have to be over 55 years old in order to make withdrawals from a 401k without penalty. So really, we have to fall back on an original option, which is called a 72T distribution. So the way this works is when Sally retires, we would transfer her 401k, it's often called a rollover or a direct transfer, from her 401k company directly to an IRA, which is individual retirement account. So those are both pre-tax accounts. Then what 72T, which is part of the IRS tax code, says is that Sally can take about 4%, which of her $900,000 balance annually. However, she has to take the exact same 4% for 5 years or until she's 59 and a half, whichever is greater, in order to avoid that 10% penalty for early withdrawals from a retirement account.
Yes, and they'd mentioned to us that they were going to use this distribution, about $36,000 a year, and direct it towards their son's tuition, because Joe's salary at this point, they felt like they would be able to live on that, and they could certainly wait maybe a couple of years until Sally hit 55 to maybe initiate her pension. At the same time, they're also going to tap savings, personal savings, as they need to deal with some of these income shortages or also to deal with emergencies. So, Joe and Sally happen to be rock stars, which is really fun, but like we talked about a little earlier, they're rock stars in the making.
That's right. And the other important thing to mention is because Joe had already been maxing out his 401k contributions, that's another source of potential increased income that they could use, meaning Joe might stop those 401k contributions if they need a little extra take-home pay, and it really wouldn't affect, the 72T distributions that we were talking about, and it wouldn't force any penalties from an IRA account in order to access those funds.
Dave, I'm glad you mentioned that, because it isn't unusual, especially when we see folks that are getting very close to retirement, that their determined retirement date, maybe within a year, 2 years, or even 5 years, to already have accumulated enough money or funds or assets inside their retirement accounts so that they really don't need to continue to make those contributions. And in their case, I think this was a very good recommendation for them to consider, that if needed, they could just stop making the contributions, take that money home, and then redirect that money to various needs. In this case, it could be income purposes. It's possible they may even need to supplement their son's living expenses a little more. Or we haven't really even discussed this, but if they had a mortgage, maybe this would be an opportunity for them to redirect these funds and maybe repay that mortgage and get rid of that obligation so that their outflows were reduced, which really makes their income and their inflows a lot more valuable.
That's a great point.
Well, super. So, again, it was kind of fun to meet with Joe and Sally early in the year. And what they had expressed to us, and this is something I'm sure that hopefully you feel if you are currently working with a financial advisor, is having somebody take a look from the outside of your situation, giving you a second opinion, giving you some ideas or thoughts or things to consider that you hadn't considered before, I think really puts you in a position where you can make smarter choices about your money. And that's really what it's all about, right?
That is what it's all about. And we have our first text question from the text line. When you can also participate if you'd like, 84126. Text us your text questions. Our first question is, my fiance is 64 and a half and plans to work until 66, but may decide to retire at 65. Should he sign up for Medicare now, even though he works for BJC and has insurance through them? Well, I would say the first decision point here is going to be, when is your fiance going to retire? This is important because Medicare allows for several enrollment periods, two of which the texter's fiance can take advantage of. The first is their initial election period. That's the 7 months surrounding the month of his birth. So 3 months before, the month of, and 3 months after. That's for individuals turning 65 that no longer have access to health insurance. So that means if the texter's fiance retires at 65, he'd no longer have access to BJC coverage. So you'd want to enroll. Or if he plans to continue working, makes it to 66, he can bypass that initial election period and use what's called a special election. Because when he does retire, he'll be losing coverage. That is considered a qualifying event, which means Medicare will allow you to enroll without any penalties, and you're able to choose exactly what you want, a supplement, a Medicare Advantage plan, as if you were enrolling for Medicare during your initial election period. Now, the reason that it's important that the texter's fiance make a decision relatively soon is that Medicare does not allow you to overlap your election periods. So your initial election period is always considered primary. So that means if the texter's fiance retires the month he turns 65 but doesn't enroll in Medicare until that month, his Medicare won't begin until 2 months later. And you cannot use a special election period to overlap that because he's lost coverage. You have to follow the rules of what the initial election period's enrollment requires. So it's important to make these decisions in advance. However, it doesn't have to be very far in advance because, for example, if he decided to retire the 1st of February, as long as he had turned in his enrollment forms and his applications, Medicare is going to give him a February 1st effective date, even if he doesn't turn everything in until January 31st. So they are flexible, but you do have to follow the rules. So it's important to plan several months in advance before you'd like to enroll in Medicare so you can make sure that your coverage lines up correctly.
Yeah, babe, the rules are easy, but they're complicated, right?
That's right. There are a lot of them, unfortunately.
And that's why, especially when it comes to enrolling in Medicare, it's good to get a second opinion, visit with a professional that can help you make sure that you're getting all the dates lined up correctly. And obviously, Aaron's one of those. So, and we helped, I think it was over 300 people last year of our listeners to enroll in Medicare plans, which is just a lot of fun.
That's right.
Easy to do, just easy to do. You can either call our office at 314-863-0008, and you'll talk with our Medicare enrollment expert, Franklin, or send Aaron an email, aaron@jblfinancial.com, or franklin@jblfinancial.com.
And just like we talked about with Joe and Sally, where there are ways to get them where they want to go, but there are certain rules governing how we can take the money, when we can take it, what creates a penalty or not. That's the same idea with Medicare. Generally, we can get you exactly where you want to go, but we need to follow the rules and make sure that we're doing things in a timely basis. So advanced planning is always important. So I say 3 to 6 months before you are going to leave your employer plan. It makes sense to reach out to a professional. And the other great thing is that it doesn't cost you anything. There are no charges for working with an individual like myself, like Frank, or other Medicare experts, because they can assist you and they'll be paid a commission from the insurance company that you select, so they can't charge you a fee, or they shouldn't charge you a fee for the consultation. In our minds, we think that probably saves you money because you'll get extra advice that you might not have gotten directly from the insurance company.
Right, and also, as you're mentioning, babe, if you call the insurance company, even one that you're thinking wanting to do business with, you're only going to get one perspective. With these Medicare plans, when you're supplementing your Medicare, there are a lot of decisions to be made here in regard to how well do your prescriptions fit, or your doctors participating in the plans, and having a professional that really can look at all the plans that are out there, looking at your specific physicians and also the medications and what you're actually receiving treatment for, can put you in a position where you can really, for the first time, make that choice about your health care. Because in the past, your employer's been making the choice.
That's exactly right. And the other great thing is, if you and your spouse happen to be applying together or applying separately based on your retirement or your ages, you don't have to choose the same thing anymore. We get to tailor this specifically to you. There are very few discounts available for husband and wife enrolling together, and in most cases, they don't outweigh the benefits of just choosing what fits you the best. So you're no longer tied to your employer's decisions, and you're no longer tied to your spouse's decisions, potentially. This gets to be geared directly towards what your needs are.
Yeah, again, I think at the end of the day, it's real important to, when you're making these type of decisions, get a second opinion. As Aaron mentioned, there's no cost to it. So contact a financial professional, someone who's licensed to represent all the companies and all the plans. If you have one, if not, you can always give us a call, 314-863-0008, or as Aaron mentioned, send us an email, Franklin, with an L-I-N, at jblfinancial.com.
Oh, we have another really excellent text question I think we can get to before our next break.
Fabulous. Let's go.
I just heard one can take money out of an IRA without incurring the 10% penalty withdrawal for paying tuition. What sort of other situations allow one to withdraw from an IRA without penalty? So these situations don't actually have an age limit attached to them. They are specific to you, which means you can be any age to withdraw penalty free if you've lost your job, if you need to pay health insurance premiums because you've lost employment. Also, if you're a first-time home buyer, you want to make a down payment on a house. Those are several examples of ways that you can access your IRA account without the 10% penalty.
And there are a couple other ones as well. One of them certainly is death.
That's right. Someone passes away.
Yes, that would be one. Obviously, new-time home buyer is another one. Also, unreimbursed medical expenses. If you don't have health insurance or you have out-of-pocket medical expenses that are really high, guess what? That would be one situation that you can make withdrawals from. Another one is permanent disability. If you do become permanently disabled, you can waive the 10% penalty. It gets waived for you. Let's see. There are a couple of other ones.
I think there are 10 to 15 different ways, and the best thing to do is log on to the irs.gov website. It's really easy to use. Just type in early withdrawals from IRA, and you will see all of the options that the IRS deems appropriate for you to make these withdrawals.
Yeah, and again, one of the key ones is one we just discussed, which was the 72T distribution, which is a way for you to pull income from your IRAs. But again, there are restrictions in terms of the minimum number of years to do that. And the IRS does provide a table which tells you what and there are basically three methods, but what those numbers really are. So
you want to get all the information before you make any decisions, because you want to make sure you're staying within the rules and the guidelines of what the IRS deems reasonable.
Yes. There's always rules, as we like to say. The Internal Revenue Code, even though it's really big and thick, is really a rule book that's made for all of us.
That's right.
Get professional advice and do that.
And before we get to our next topic, I think it's time for our next break.
There we go. We've got to have people pay for this show. So, again, I'm Jeff Lapidus, the retirement coach.
I'm Erin Lapidus, the retirement coach.
We'll be right back after these messages.
Hey, KTRS listeners, Roger Wigginton here at Don Rogers Limited in Belleville. Well, we're through the holidays, heading into the new year. And don't ask me where 2021 went, because I don't have a clue. These years just go by faster and faster. But all I do want to say is I thank all of my wonderful KTRS listeners for their patronage. We're going to be here in 2022 with great men's and women's apparel. The store will always look good. We'd love to meet you. And my prayer for 2022 is health and happiness. That the world gets back on track, that this country gets back on track. Can we get through all of these problems that we've had the last 2 years? So as we move forward, we're here all the time, 6727 West Main in Belleville, 618-398-2421. Our spring merchandise will start coming in shortly. And just remember, if you shop at Don Rogers Limited, people will say to you what they say to all my customers is that a Don Rogers.
It's the one gift that's perfect no matter the season. The gift of love from a rescue at Yuppie Puppies Forever. Yuppie Puppies Forever is a nonprofit rescue group focused on orphan dogs due to deceased pet parents and provides a safe place with all the comforts of home. Yuppie Puppies Forever uses the matchmaking process to set everyone up for a lifetime of success and happily ever after. Visit yuppiepuppyspa.com to learn more about adopting or donating today. The gift of love is waiting for you at yuppiepuppyspa.com.
If you're turning 65 this year, you face one of the most critical choices for your retirement game plan: enrolling in Medicare Part B and choosing your Medicare supplement. I will help you safely navigate this process and find the health insurance plan that best works with your new Medicare coverage. Getting started is easy. Call me at 314-863-0008, 314-863-0008 to arrange for a free health insurance coaching session, or email me at erin@jblfinancial.com.
Now is when a small change can make a big difference. If you're not happy with your current Medicare coverage, take a look at Coventry Healthcare. They have a wide range of plans with great service and clear costs, including medical and drug coverage in one simple plan. Just call 1-855-338-9551, 8 a.m. to 8 p.m. 7 days a week. That's 1-855-338-9551. Now's the time to call Coventry Healthcare.
This is Erin Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email at erin@jblfinancial.com to arrange your free coaching session. Let's get started on your retirement game plan today.
Now back to Straight Talk and Retirement on the Big 550 KTRS. Here's Jeff and Erin Lapidus.
That's right. We're back with a little more Straight Talk on Retirement with my wonderful daughter. You have to redo that promo, though, babe.
Okay, I was just getting tons of compliments about that promo, so I don't know even what you're trying to say about me right now.
It sounded like you had COVID or something. I mean,
my gosh.
You didn't have the excitement level up because we know that.
Rude. Where's your promo?
Well, it's fun. I mean, planning for retirement, having coaching sessions with folks, being invited, as I like to say, into the back seat of their
I was literally getting lavished with compliments just moments ago, like during the break. It sounds great. It was your first take, and now this is what I get on the air. Rude.
Who loves you, baby?
Obviously others, just so much more.
That's right.
That's right.
Nobody like your dad, okay?
Right.
That's all I can say. Well, again, we're back with some more Straight Talk on Retirement. It was fun as the first hour seems to be flying away, but the hour of power, the second hour is on the way just after the next couple of minutes and the commercial break. So we do want to remind everybody that Aaron and I are having a lot of fun here, but what's more fun is answering your questions, 314-931-5877, star 5877 from your cell phones, or 84126 from the Getting Warmer. Heating up. Excellent.
We do have some more text questions that I would love to get to, so I could not be insulted on the air any longer. Let's start with our next text question. Can an individual open up their own IRA and be their own custodian? They are called if you're a bank. So a custodian is another term for a bank. You can open up your own individual IRA account, meaning you don't necessarily need an advisor to assist you in doing that. So you could go to your local bank. Many local credit unions also have advisors available to you that can assist you with this. But you do need to use either a credit union or an FDIC-insured bank because they're going to do a couple of things for you. One, you'll have a platform to invest those IRA assets. And different banks allow for different types of investments. There are specialty IRA accounts that allow you to hold physical gold, things like that. Many just with traditional mutual funds or other securities.
Yes, and obviously you can also do it directly with an investment advisory firm, maybe a mutual fund company. We're not allowed to talk about what the big numbers are, or obviously through a financial advisor,
which all have custodians associated with them.
Yes, and again, the purpose of the custodian is primarily, number one, to safeguard your assets from being stolen. And the second one is that they're also the ones that are required to do the reporting to the Internal Revenue Service every year on what your contributions were and what the value of those accounts are at the end of the year. And
what your distributions have been if you're taking them. Yes. If you're 72 and need to take required minimum distributions, they're going to do the calculation for you and also report to the IRS that you have actually taken that money.
Yes, so at the end of the day, you could be the captain of the ship.
But you have to borrow the ship.
Exactly, but you have to use a separate third-party custodian. And as I like to say, most folks don't realize that the bookie, that is the firm that's actually making the trades or purchases for you, aren't permitted to hold the money.
That's why when you hear about the major that's why you hear about when you hear major banks in the United States, they have an investment advisory arm that's often called something else. We can't mention specific names on the air, but most of you have heard of large banks that also have advisory firms associated with them.
Yeah, we are allowed to mention ours. Our broker-dealer is LPL Financial. That's the one who we use to book our trades through. They're the largest independent advisory firm in the country. And they do own a bank, commercial bank actually, a trust company that's called Private Trust Company that actually serves the custodial function for all of our clients. So the bookies, they never hold the money.
Nor do advisors ever hold the money. So if you're working with an investment firm, but you don't have an advisor assigned to your account, so you are directing your own investment decisions, you have two participants in your account: the investment advisory firm, and then also the custodian. But if you're working with a financial advisor, you have three separate entities involved with your account: your investment advisor, the bookie, like my dad likes to call the broker-dealer, and then also the bank or the custodian.
Exactly. And all checks are always, any check that you're going to cut to someone or have money transferred always gets transferred to the custodial firm, never to the advisor.
That's right. So it's made out to, for example, for our firm, LPL Financial, for the benefit of the individual whose account that the money will be directed into. So it has the custodian's name and your name on it, so no one else can cash it anywhere else but in your account at the firm.
Yes, and the other thing is that custodians do maintain what we call SIPC insurance, which is required to protect your money from theft
and fraud, which is just like FDIC or very similar to FDIC insurance that you hold at the bank. However, this is for investment accounts.
Very good. So, great question. We got a few laughs out of it, and hopefully we're able to give you some good information.
We have another text. We have a couple of other text questions up on the line.
Well, fabulous. Let's see how many of these we can get to this hour, and we'll just carry them over to the next hour.
Perfect. I will be 64 on Valentine's Day.
Woohoo.
That's great. I've asked to have someone hired that I can train for when I retire. I like the planning in advance. It has not happened. That is unfortunate. At least someone was on the ball, though.
If I got something to do this year, right?
That's right. If I decide to take my retirement before 65, how should I handle my insurance situation? I do have company coverage right now. Well, this is a great question. There are many individuals that are looking to retire before the age of 65, and they need a way to bridge to Medicare. We don't have a lot of information on this texter, but potentially if their spouse is still working, then they may decide to jump on to their spouse's coverage, which they could stay on until their spouse retires, or until they get to the age of 65 and decide that maybe Medicare is more cost effective for them. Sometimes that happens, and we're always willing and able to do that comparison for you. If you're not married or your spouse does not have coverage, COBRA most likely is going to be an option for you. You'll have 18 months of COBRA, which is more than enough to bridge you to Medicare. The prices might be a little bit higher, so you will want to consider that into your retirement game plan and cash flow. But that's going to be for a very protracted amount of time because you're turning 64 next month. So we're only talking about 8 to 10 months potentially of COBRA coverage before you're able to access Medicare. The third option would be to compare your COBRA. We have an update from the texter. The spouse is retired, so I guess that probably means that we would be looking for coverage for two people, not just one. So the final option.
Yeah, well, actually, there is one other option that you haven't mentioned.
I was about to. I'm going for it right now.
What if they own the place?
I don't think they own the place because then they wouldn't have had to ask to hire someone, right?
Not necessarily. I mean, having a succession plan is a good idea, but I was going to suggest that as a part of their employment agreement, they could negotiate. We've seen this happen very often in the past, that coverage would be continued and be part of their compensation until the time they reach Medicare eligibility. Or
the very final option, which I didn't think of that one, so excellent point, Dad. Always the negotiator. You might be able to negotiate compensation, health insurance premium payments over compensation or some combination thereof, but the final option would be you do have the opportunity to look at the health insurance marketplace. Many people refer to this as Obamacare, and this is also something that we can assist with, which is comparing your COBRA option to what you could find on the exchange or the health insurance marketplace. And depending upon your income, we may be able to work a subsidy for you. So you do have several options. You have COBRA, you have the potential to possibly negotiate your health insurance premiums being paid until the new employee is trained, or we have the health insurance marketplace available to you. So there are 3 ways that we can help you bridge yourself to Medicare so you won't be without coverage in this interim between 64 and 65 years old.
It sounds fabulous. And I know that we're getting very close to the end of our very first hour.
That's right.
And we do want to remind everybody that we will be on for a second hour at our normal time, our old normal time, right?
Our
from 10
original
to
time.
11 exactly, from 10 to 11 a.m. And if you're interested in visiting with Aaron or I, it's easy to do. Just give us a call, 314-863-0008, whether it's for a health care coaching session or a financial coaching session or a combo.
And we'll be right back after the news.
The talk of St. Louis for 25 years. KTRS AM, FM 1061, K291CW St. Louis.
From ABC News, I'm Brian Clark. The sheer number of new COVID-19 cases, over 4 million in the last week, are leading to an uptick in hospitalizations. That's having an impact across the healthcare system.
Health officials say the massive surge in Omicron cases means hospitals are having to put off other important medical procedures.
Procedures like colonoscopies, mammograms, as well as chemotherapy and dialysis all get postponed and delayed, so all patients are negatively affected by this.
ABC News medical contributor Dr. Darian Sutton says vaccines help keep people out of the hospital and reduce strain on the healthcare system. Mark Remillard, ABC News.
At the same time, President Biden hinted Friday the nation could be heading towards a new normal.
Having COVID in the environment here and in the world is probably here to stay. But COVID, as we're dealing with it now, is not here to stay.
The Supreme Court heard arguments Friday regarding his administration's vaccine or test mandate for large companies. During questions, Judge Clarence Thomas asked,
how are we to decide when an emergency temporary standard or emergency temporary standards are necessary? What factors do you think we should use?
A decision is expected quickly. Sentences were handed down for the 3 men convicted of murdering Ahmaud Arbery in 2020.
As to Travis McMichael. Mr. McMichael, the court sentences you as follows. Count 1, malice murder, life without the possibility of parole.
State law required the judge to hand the 3 men who murdered Ahmaud Arbery life sentences, and the only mercy he could show was to allow them to be eligible for parole after 30 years. But for Travis McMichael, who fired the fatal shot, and his father, Gregory, a former police officer, the judge refused parole. They will die in prison.
That's ABC Steve Osunsami. A third man must serve 30 years before he'll be eligible. You're listening to ABC News.
What's all the buzz about nasal irrigation and Navage? And should I try it? Here's the science. Airborne germs invade through your nose. It's the body's air filter for trapping allergens and viruses. When your nose gets clogged, it's less effective and germs multiply. Eventually, your immune system can get overwhelmed and you get sick. Nasal irrigation is an effective, all-natural way to clean your nose. It's not a drug, it's more like plumbing. Saline goes in one nostril, around the back of the nose, and out the other nostril, flushing out mucus and germs. I'm Martin Hoke, and I invented Navage to make cleaning your nose easy. It's the world's only nose cleaner with powered suction. Navage pulls out the bad stuff so you can breathe better, sleep deeper, snore less, and feel healthier. At Walgreens, CVS, Rite Aid, Target, Bed Bath, and Walmart. Or go to Navage.com for a free gift with purchase. Over 2 million sold. Navage, Navage. Clean nose, healthy life.
President Biden will be one of the several prominent Democrats to speak today at the Las Vegas memorial service for Harry Reid, the former Senate Democratic leader. Friday, the president was in Colorado, where he toured areas that were damaged by last week's wildfires. Human remains were discovered on the site of the deadly blazes.
It took DNA to identify the partial human remains found in the fire zone. The Boulder County coroner now saying they belonged to 69-year-old Robert Sharp of Boulder. The cause and manner of death are unknown. His family says Sharp worked for many years in the construction industry and was a longtime Boulder resident. Investigators are still trying to figure out how the fire started, now ruling out downed power lines.
That's ABC's Alex Stone. Tennis star Novak Djokovic remains in a refugee hotel in Melbourne, Australia, ahead of a legal appeal to his deportation on Monday. ABC's Britt Clennett has more.
Novak Djokovic is currently staying in a hotel which has been criticised by refugees for its poor conditions until his court appeal on Monday. His mother recently spoke on the poor conditions of the Park Hotel.
If it's hotel at all, with some bugs, they are keeping him as a prisoner. It's just not fair. It's not human.
Can't afford to tolerate the rampant false temperature readings from non-contact thermometers. Accurate temperature measurements are essential. You need Exergen thermometers because they are accurate and backed by over 100 clinical studies. Be sure, be accurate with Exergen. Learn more at Exergen.com.
Brian Clark, ABC News.
Now back to Straight Talk and Retirement on the Big 550 KTRS. Here's Jeff and Aaron Lapidus.
That's right. We're back here on the Big 550 KTRS Talk Radio St. Louis for our second hour of Straight Talk on Retirement.
That's right. If you're just tuning in and you're shocked that you haven't heard the intro, it's because it was at 9 a.m. where it will be moving forward.
Exactly. 2 hours and a lot more fun with all of you. Again, our phone lines are open. We'd love to hear from you. 314-931-5877, star 5877 from your cell phones, or 84126 from the text line. Honey, I know that we do have some other text questions that we've held over from the first hour, and we want to get to them, but I know we've got our super-duper special guest, fascinating, fabulous Frank.
Hello.
Our health insurance expert.
Good morning.
That's right. He's here, ready to go for our health insurance topic of the week.
There we go. Welcome, Frank. Go for it, my friend.
Oh, yeah. Let's take it away.
All right. Well, hello, ladies and gentlemen. I am the fascinating Frank, and we're going to talk some Medicare this morning. So, I put together a little segment of some things that have been happening that I've seen more recent after AEP at work. And what I'm starting to see are a lot of people are starting to retire.
People at the beginning of the year looking to retire either sometime soon or within the next 6 months or so. They're already getting their plans together, and that includes health insurance.
Exactly. Bingo. And these folks are retiring maybe, like you said, in the next 6 months or like the next 3 months, maybe even the next year. I've seen a couple throughout that long, too, even the next year. And they're wanting information on how do they come on to their Medicare and what sort of enrollment would they have.
Sure.
So I had the pleasure of meeting with Jim and Julie last week, and I kind of feel like we have a lot of Jim and Julies.
You know, they're very similar to Bob and Sally. We have several. We love them all.
We love them all, yes. So Jim and Julie came to me last week. Jim is 70 years old. His wife, Julie, is 63 years old, so she is not of Medicare age yet. Jim wanted to know how he is, what his insurance was going to look like, once he retired. How was he going to get on to Medicare? If there were going to be any penalties, what sort of enrollment he would get.
Sure.
Okay, so Jim had been hearing from his friends that he made a mistake not coming on to Medicare whenever he was 65. His friends had mentioned something about a late enrollment penalty for his Part B and for his medication, his prescription plan, your Part D of Medicare. So he contacted the office. I spoke to Jim. We got him set up with Kelly. She gave him a questionnaire. Jim came to the office. He set up his appointment. He got the questionnaire back to me within 48 hours of that appointment, of course.
Great.
And I sat down, and the first thing I told Jim was never listen to your friends. Never listen to your friends.
We'll take responsibility for the things that we say, but it's rare that your friends are going to take responsibility for the things, especially about Medicare, right?
Exactly. And Medicare is one of those things that it is so broad that they give you so many enrollment opportunities, and also plans are designed specifically for you.
Sure.
So your friend may have a plan, but that plan might not be specifically the best plan for you.
Also, your friends have enrolled in different times in different ways, so it's important to, like you said, Frank, get some extra advice on what's going to be best suited for you.
Exactly. So Jim and I, we sat down, and I let him know, Jim, everything is going to be okay.
Right.
All right. The first thing we went over is his special enrollment period. Now, a special enrollment period for folks out there that don't know is after you've turned 65 years old, Medicare is going to allow you to come on to Medicare Part A and B and your D with no penalty as long as you've had credible coverage through your employer or your wife's employer.
Or husband's employer if you happen to be a lady. Just depends. But in Jim's case, yes.
Exactly. In Jim's case, he was on his own coverage and his wife was on his coverage. Again, his wife was only 63, so she's not of age yet to come on to Medicare.
Sure.
But for Jim, since he has held on to that employer's coverage, he's going to get that special enrollment period through Medicare.
So how does he access his special enrollment period?
That's a great question. So what you'll want to do is you'll actually get the documentation from me.
Which is, we make it easy.
Make it extremely easy. We streamline the process for you folks. What happens is when you come to the office and you fill out that questionnaire, we're going to go over our meeting, and then I'm going to give you some homework.
A little bit of homework, not much.
Not much. I promise you, not much. The first piece of paperwork that you'll need for that special enrollment period is just some information from the HR department that you currently have your coverage from. And basically, they're just going to give us the information that from the time you've turned 65 that you've had that credible employer's coverage.
And that's called the Request for Employment Information document that Frank will supply to you during the appointment.
And the second piece is going to be the Part B application, enrollment application for Medicare. You yourself physically will fill that out, but the HR department will fill out the request for employer's information.
Exactly. So you'll take both of those pieces and return them to Frank, and he submits them to Social Security for you.
Once I submit those off to Social Security, turnaround times, I want to say about a couple of weeks or so, and that'll get you should be enrolled in your Part B, and you should have a Medicare number after about a couple of weeks or so.
Right, and Part B really is the key to getting the rest of your coverage, which is that supplement or Medicare Advantage plan.
Exactly. So once you have those two forms, you're pretty much 50% done with your Medicare. Once you knock out A and B, and you get me those two documents back, you're pretty much done with your Medicare. The only thing from there that we would be doing is setting up your secondary, basically.
Sure.
And your Part D, of course. So one of the things that Jim wanted to know was if he was too late or if he was too early, how soon should he be doing this type of stuff?
Sure. So when did Jim want to retire, or when did Jim want his coverage to begin?
Jim wanted his coverage to begin next month, so February 1st. I believe Jim came to me actually January 6th. So we were working with a little bit of a window there where we needed to get those documents back from him within the next week or two.
Sure.
To make sure that he gets all of his cards and his summary of benefits and all of that type of stuff before the end of the month.
So generally, in order to make it a completely smooth process, you'd probably recommend that if individuals are retiring and looking to use a similar election to Jim, that special election, that they give us a call maybe 3 months in advance of when they're planning to retire?
Absolutely. I think that is ideal. You're going to want about 3 months because Medicare, there's a ton of information out there. When we go over these plans, there's a lot of information out there. You may want to take that and digest as I'm doing the paperwork and as paperwork is getting processed. So 3 months, I would say 3 or 4 months is a great timeline.
Right, because you'll come in, you'll meet with Frank, he'll go over your options, and as opposed to having to make, as opposed to it being a pressure decision or having to make that choice immediately, you'll have some time to think about things, but we can already get the ball rolling on the Medicare piece of things, which you absolutely have to have. The other nice thing is Medicare doesn't ask you what you're selecting, so we can start the ball rolling in terms of getting that paperwork in. And you will still have time to think about it. If you have more questions for Frank, there'll be time to get those answered as opposed to rushing through the enrollment and then having questions on the back end after you're enrolled.
Exactly. And again, your special enrollment period is for the folks that have held on to that Medicare coverage. They're getting ready to retire, so they're coming off of retirement, and they're going to leave that employer's coverage.
Right.
Medicare is not going to penalize you for that. No matter how old you are, 65 and above, no matter how long you hold that employer's coverage, there is no threshold on that right now.
Absolutely. That sounds great. So tell me a little bit about what the process is once he comes to the office. You've given him the special election paperwork. What's the conversation like regarding those secondary options?
Yeah, so we sit down and we talk about those secondary options, which are going to be, the traditional Medicare side of things versus the Medicare Advantage side of things. Now, coming on with his SEP, he can select any plan without any sort of pre-existing conditions mattering, or without any sort of underwriting. So it's not an approval process. He's going to automatically be able to enroll in either traditional Medicare or a Medicare Advantage plan.
We call that a guarantee issue. So that means that as long as you pay the premium, they are required to give you the coverage as long as we get you enrolled within the proper time frame, which is, why we suggest we get a little bit of lead time to make sure that we can line everything up for you the way that you want it.
Mm-hmm. So when we're looking at these plans, traditional versus Medicare Advantage, Jim came to me fairly healthy, just on a couple of prescriptions, just your typical tier 1 losartan, levothyroxine sort of prescriptions.
So those generics.
Those generics, yes. So when I'm looking at something like that, someone who hardly ever goes to the doctor, Jim didn't even have a specialist at this point. He just
nice
had a
to
primary.
be healthy, guys. Right.
It pays off to be healthy. So when I'm looking at that and we're making decisions on based off of his health, based off of his medications, where can we get the maximum amount of our benefit for the least amount of dollar?
That's what everyone wants when it comes to health insurance.
So we're looking at traditional Medicare, and those are those plans that you pay monthly for versus the Medicare Advantage plans, the plans that you don't have to pay monthly for. When I see someone is very healthy like that and they're on, a couple of generics and they got, 1 or 2 doctors, maybe they go to the doctor a couple of times a year, doctor tells them, come see me next year.
So low usage, you're not seeing the physician often, you don't have rehab to do or regular scans to have because maybe you're a survivor of cancer or you're just finishing treatment, things like that.
Exactly. So whenever I see that low usage, as you said, just like that, I automatically think, okay, we're probably going to be leaning towards a Medicare Advantage plan.
Because that's a pay-as-you-go, right? You don't have to pay the premium up front. You just get to pay when you actually use the plan.
That is correct. So again, like you said, no premium up front. You just pay co-pays as you use that plan. So someone like Jim, he's going to absolutely love that style of plan, because while he's healthy right now, he's not paying an insurance company $150, $160 a month. He's just paying, when he goes to the doctor to see a specialist, $35. So he goes to the specialist. I asked him, how many times do you go to the specialist? He goes twice a year. And like I said, doctor tells him to go home. Or his primary tells him to go home. So essentially, he just spent $70 for his health care out of the year.
And also, he's going to get a bunch of extra benefits with those Medicare Advantage plans that the supplements where you are paying up front don't actually provide to you.
And that is correct. And those plans are designed to incorporate those benefits. So we're talking benefits like your Part D already included in the plan at no additional cost. Other benefits like dental, vision, and hearing benefits that they're going to give you as well. Also, really cool, that I think is really cool, is some over-the-counter benefits. They're going to give you money to buy stuff over the counter, whether that be ibuprofen, first aid stuff, whatever.
Allergy meds, which so many in St. Louis are in desperate need of.
Allergy meds, all of that. They're going to take care of all of that for you. They'll send you money each quarter. So these plans, they have some cool things in them.
Right, so it's important to hear about what your options are, and the best way to do that, and that's the reason why we request that questionnaire on the front end. It's pretty simple. It's just, where do you live, so we can make sure that we know what plans are available in that service area. Who are your physicians, so we can make sure you can still see them, and what are your prescriptions, so we can tell you exactly what it's going to cost and where you can fill them.
And that's the lovely thing about these Medicare Advantage plans is that they're very transparent. You get to know how much you're paying, for instance, lab work. You're going to know what your copay is before you even walk in the door. So these plans are very transparent. Again, $0 premium plans with a lot of great benefits added into them.
That's excellent. And you know what? Before we wrap up our health insurance segment, we do have Paula on line 1 who has a health insurance question. Good morning, Paula.
Hi, good morning. I think you already answered most of my questions regarding, my question was, how long can you stay on your employee health insurance plan? As long, it doesn't matter, apparently, your age. Is that correct?
That is correct, Paula. And how are you? Good morning.
Good morning. And my next question would be, I am receiving Social Security benefits, and I did not apply for a Medicare card, but along with my benefits came a Medicare card. So who is the primary? It's only Part A. I am not enrolled in Part B. Who is the primary insurance if I would go to the hospital?
So your employer is going to be your primary right now since you only have Part A.
But potentially, Paula, you will want to show that Medicare card because your Medicare Part A benefit is just the hospital benefit. And if you happen to be admitted to the hospital, you'll show your employer card. You'll also show the Medicare card, and it might give you some additional benefit. The nice thing is you're not going to be charged a monthly premium for that Part A, and you've already completed 50% of the work just by enrolling in Social Security to get to your Medicare Part B benefits. So just like Frank discussed about Jim, that you'll just fill out those other two pieces of paper when you decide to retire to get your Medicare Part B benefit without any penalty. And then you'll be able to choose a supplement or a Medicare Advantage plan like we were chatting about Jim's situation with being able to choose whatever you like, guarantee issue.
I got it. Thank you so much.
Thank you. Very good.
Yeah, great question. Glad we were able to read Paula's mind.
Yeah. Very good.
All right. Well, anything else that you would like to add about Jim and Julie for our listeners this morning?
So just a quick recap, folks. Again, that SEP.
Special election period.
Special election period is for folks that are 65 and over that still have their employer's coverage. I just want people to know that you're not going to get penalized as long as you hold on to that coverage.
Right, and if you happen to be in the situation like Paula where it sounds like she has coverage through work, but she's also elected Social Security, she received a card in the mail that has just her Part A benefits on it. That's because every time you enroll in Social Security, they're automatically going to enroll you in Part A. That doesn't mean you'll be enrolled in Part B. In fact, most of the time, if you are working, you'll take the Part A, not the Part B, and then you'll be able to enroll down the line whenever you actually decide to retire.
Mm-hmm. Very good.
Very cool. Well, thank you, Frank, for joining us this morning. We really appreciate it.
Thank you. Hope Jeff is nice and warm out there.
Just rubbing it in.
It's 45 degrees out here, but I did turn on my space heater, so I'm doing very well. Thanks for asking.
That's like tropics compared to where it is here right now.
Yeah, it is.
I understand. And, it was great having an opportunity to listen to you guys. And I'm sure that our listeners probably got the idea that we know what's going on when it comes to Medicare. So when you're getting ready to consider making this change of life, i.e. your retirement, it's a good idea to at least start about 3 months in advance. Give our office a call, 314-863-0008, or send Franklin an email, franklin@jblfinancial.com, or if you're working with somebody, give them a call. We're obviously here and happy to help you as we have many of our listeners over the year. So it's a lot of fun.
It is a lot of fun. Now, Dad, there is a text question that I cannot answer. I know, it's shocking. Does KTRS plan to rebroadcast the first hour of the show at some point?
The answer is no. They're not.
You're going to have to wake up early with us in the future, guys, 9 a.m.
That's right. Or you'll need to wait a week or so, and what they'll be doing is they'll be putting our show in its entirety up on the website.
Oh, very nice. And hopefully, months from now, when our compliance department approves the show, it'll also be available on our website, jblfinancial.com.
That's right. And you know that if you are within 5 years of retirement, you're getting ready to retire, you'd like to come in for a second opinion, you want to come in for a coaching session and get that game plan done, it's easy to do. Just give us a call, 314-863-0008, or send us an email, aaron@jblfinancial.com, or really go to our website and hit the Contact Us section, right, babe?
That's right. And before we take our first break of the 10 o'clock hour, we did have what seemingly random text message that I think is important for everyone that has New Year's resolutions. Dark Horse, oh my goodness, wait, hold on a second. Dark Horse Cabernet has 0 carbs. So I guess if you if you enjoy wine and you are also deciding that you'd like to lose a few pounds, you still want to enjoy that glass of wine, especially because it's negative 27,000 degrees outside. Dark Horse Cabernet has no carbs. I don't know how many calories it has, though. That will be another question, I guess, for another day.
Well, that's great. I guess it's time then. Let's take our first break of this hour. I'm Jeff Lapidus, the retirement coach.
I'm Aaron Lapidus, the retirement coach.
And Franco Ellis, the Medicare coach.
That's right.
There you go. Don't you dare touch that dial. We'll be right back.
At Charmin, we heard you shouldn't talk about going to the bathroom in public, so we decided to sing about it.
Get ultra strong for your South Pole. Charmin keeps your undies whiter than the North Pole. A shiny hiney, a brand new year. Come to us, Charmin. Happy New Year. May your holidays be Charmin, clean, merry, and bright. May all your undies be Charmin, clean white.
Charmin Ultra Strong just cleans better. Enjoy the go with Charmin.
You know the doctors, but you may not know the name Sound Health Services. They offer the convenience of a large group practice with multiple office sites and prompt appointment scheduling. The doctors at Sound's 12 locations provide excellent care for ear, nose, and throat conditions, hearing and allergy care, dizziness and balance issues, as well as voice and swallowing conditions. Make your appointment now, 314-729-0077, or visit soundhealthservices.com.
Terry Hall here. This Week in Real Estate. Are you thinking about buying or selling your home this year? Call me. I have sold over 4,000 pieces of property, and it is impossible to pull the wool over my eyes. Therefore, it's impossible to pull the wool over my clients. Find out how to sell and make a lot of money. Find out how to buy and save a lot of money. Sundays at 1, Sundays at 2. This Week in Real Estate with Terry Hall.
If you're turning 65 this year, you face one of the most critical choices for your retirement game plan: enrolling in Medicare Part B and choosing your Medicare supplement. I will help you safely navigate this process and find the health insurance plan that best works with your new Medicare coverage. Getting started is easy. Call me at 314-863-0008, 314-863-0008 to arrange for a free health insurance coaching session, or email me at aaron@jblfinancial.com.
Now is when Coventry turns confusion into clarity. Coventry Healthcare has got a simple approach to care. By listening to their members, Coventry can make plans that work harder for you and your budget. The result? They offer great service and clear costs. If you're looking for a plan that's more about you, give them a call at 1-855-338-9551, 8 a.m. to 8 p.m. That's 1-855-338-9551. Now is the time to call Coventry Healthcare.
This is Aaron Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email at aaron@jblfinancial.com to arrange your free coaching session. Let's get started on your retirement game plan today.
Now back to Straight Talk and Retirement on the Big 550 KTRS. Here's Jeff and Aaron Lapidus.
That's right. We're back here on the Big 550 KTRS. It's halfway through the second hour of our show, Straight Talk on Retirement. I'm Jeff Lapidus, the retirement coach.
I'm Aaron Lapidus, the retirement coach. We are willing, we are waiting, we're wanting to answer your questions at 314-931-5877, star 5877 from your cell phones, or 84126 from the text line. And we obviously want to thank everybody so far this morning for making our first hour and a half fun and enjoyable, for supporting us by giving us a call, sending us texts. Keep them coming, folks. We have a pretty... answer those questions. That's right. We have a lengthy text question all queued up on the text line 84126. If you have text questions, you are more than welcome to send them over. Well, lay it upon me. All right. Months back, we established a revocable trust with an attorney's office and thought we'd change the names of our credit union accounts to this newly established trust. In contacting our credit union for verification, I now find out that the accounts were not renamed, but the trust is now the named beneficiary on all of our accounts. Could this create a problem or possibly send these accounts funds to probate when the trust is implemented? Our credit union says we would have to close all of the existing accounts and reopen all in the name of the trust under my social security number because the name of the trust, or the trust is currently under, obviously, the husband's social security number because, unfortunately, the financial services area is still a little sexist, and it usually still goes with the husband's social. Until you pass away, then the trust has its own tax ID set up.
Yes.
So I do not. So no. This will not create an issue in terms of probate when you pass away because the named beneficiary of your accounts is the trust, which means the money would flow into the trust. However, it shouldn't be too much of an issue for your credit union to open those new accounts in the name of the trust, which I think is generally preferable to just having those accounts still as probably what you have as joint accounts, I'm assuming.
I think I would agree with you. They basically created what we would call a POD or
a TOD,
payable on death account because generally you can't name a beneficiary to an individually or even jointly owned account without that designation. So make your lawyer happy and open up those new accounts. And frankly, it's probably a good idea to do this. I don't know, within 30 days when your checks are running out, right?
I agree with that. So if something were to happen to you in the interim, there will not be an issue. Those funds will not go to probate, but sometimes it takes a little bit longer for the trustees to access those funds because you have to wait for the bank to read through the trust and agree that these individuals have access to this money, or they have to set up the new trust account. Your trustees will have to get the tax ID number, which can take a week or two. So really all you're doing is making the process a little smoother for your loved ones that you are leaving the assets behind to by having it already in the name of the trust, because then they can just show the trust document, show that they have control of those assets, and then they can begin to distribute them the way that the trust deems, or they can use some of those funds if they happen to be checking accounts to close out your estate, meaning, if there's funeral expenses, if they have, the tax return that has to be filed. Also, if you have property taxes due, things like that, it'll just make it a lot easier for those individuals.
Yes. And to be real, you spend a lot of money in having a trust document created. It's probably best to follow through with it.
And there's no charges to you to open those new accounts. That should be part of, what the work of the credit union does for holding your money.
Yeah, and you're going to have to pay for new checks. So usually the timing on that is really not such a bad thing.
Exactly. And you know what? We have Brian on line one who has a retirement question.
Hey, Brian, welcome to the show.
Good morning. Love your show.
Thank you.
Quick question. I hope I can get this right. I'm not super knowledgeable about this stuff. I have a life insurance annuity that I carried for about 10 years, or paid on for about 10 years. And I'm 59 now. Don't really need to be paying on it, but it's worth now about $45,000. And I talked with the gentleman that I purchased it through and everything, and he said it will keep accruing interest tax-free at about 4% or so. Is there any other options I have for this money?
Babe, you want me to try to tackle this?
I know this is one of your favorite topics, so I would not stand in your way.
Great. So, Brian, again, first of all, thanks for the call. Really good question. I'm going to make an assumption that the payments that you've been making to this annuity have been after-tax payments, basically out of your checking account and accumulating every month, and that they're not a part of an IRA. Is that correct?
They are not. No.
Okay. So let me frame the language a little bit better for you, and I think it'll help you as well as the listeners. The interest that is being accrued inside of this annuity contract right now is not tax-free. It's actually income tax deferred. So
deferred. I'm sorry. Yes. Okay.
That's okay. You're welcome. I wanted to clarify that because we know that there's tax ramifications if you decide that you want to open this up. One of the issues that many folks have, and is that they don't want to open them up. I mean, they've deferred paying interest, the taxes on the interest that's been accruing in this, and they're looking at it. In your case, if you put in $20,000 and now it's worth $35,000, well, we know that when you begin to unravel this contract, you begin to make withdrawals. If the IRS requires you to withdraw the interest first, and that's going to be taxable as ordinary income. You do have several things that you can do at this point in terms of dealing with this contract. Number one is that if you're thinking about using it for retirement income purposes, as we talked about, and we do talk about in our newsletter this month, is one option could be annuitization, which is basically saying to the insurance company, you take this lump sum, in exchange, give me a fixed income, either for a certain period of years, maybe 10, 15, or 20, or I want a lifetime income. And in exchange for that lifetime income, they'll take that money. Now, what will happen is when they do that, the IRS has a very special part of the code that says you don't have to pay taxes on the entire distribution. Each distribution will be apportioned between principal and interest. So use a simple example. Let's say that, again, your annuity was worth $40,000 and you had put in $20,000. So we know half is interest and half is principal. So therefore, each payment you would receive on a monthly basis would be half principal recovery, no taxes, and half interest recovery, which is ordinary income taxes. That would be one thing. The second option that you could consider doing is that if you held this for a long period of time, which it sounds like you may have, you're probably out of what we call the surrender period, which means that you could possibly, if you're finding something, another annuity, that may provide better features or values for you, you could do what's called a tax-free exchange, which is transferring this money from the insurance contract directly to a new insurance contract, a new annuity contract, and there would be no tax ramifications. Again, you don't want to touch the money, but this has to be a insurance company to insurance company transfer, very similar to what happens with your 401k or IRA plans, where you're transferring it from an employer plan to a self-directed IRA. That would be number two. Number three would be, obviously, you can make withdrawals. Start pulling interest out of that contract, and again, paying tax on that. And that might make sense to you, especially when you do enter your retirement, because at that time, you may not be in a situation, many folks are, but your income will have gone down, and therefore you'll be in a lower tax bracket or equal tax bracket. And therefore what will happen is that the income tax impact on this contract won't be so significant for you.
I understand.
So those are really the options that you have. Again, if you surrender the contract, you have to pay taxes immediately on all the interest that was accrued.
Okay.
What were your kind of thoughts behind how you were thinking about using this contract?
I wanted to use it for retirement money. I'm not depending on it or anything like that right now at this time. That first option that you had spoke of, would that be a monthly payment that they would make out to me?
You can have it set up monthly.
Go ahead, babe. That's right. Monthly is certainly one option. They'll send it to you any way that you want, whether it's quarterly, semi-annually, or annually. Okay. One thing that came across my mind here as we're talking is, since you're just getting ready to turn 59 and a half, I believe. Yeah. Maybe what you might consider is, and you'd have to be talking with I think I would suggest you talk to your financial advisor about this, is that instead of maybe taking a lifetime income, maybe what you'll do is maybe take a shortened period, let's say what we would call a 10-year certain payout, where they would divide the contract and pay it out over 10 years. If you were to predecease or die before the 10-year period, your beneficiaries would certainly get the balance. But maybe by front-end loading the payments out of this contract, what would happen is that might put you in a situation where you could have an easier bridge to Social Security, which possibly be age 62, or even put you in a position where maybe you could put off taking your Social Security a little bit more, improving that benefit versus taking it early.
Sure. I understand perfectly. Boy, that's great. All right. Well, you've really cleared up a lot of things for me. I sure appreciate it.
Well, again, we appreciate your questions and your calls, and just like the rest of everybody else that might be listening, give us a call. We'd love to hear from you. And Brian, have a great day.
Well, we have another text question that's come through, which is great. This is a little bit more technical, but we're happy to get into it. What are the rules/issues for switching from a Medicare Advantage plan back to original Medicare and vice versa if you happen to have started on original Medicare?
Well, you're the expert, babe.
I'm going to try and make this as swift and simple as possible. Medicare Advantage plans give you one free look, which means you have 1 year to decide if you like it. This means it could be your initial election, so the first time you come onto Medicare, you've chosen Medicare Advantage, or it could be down the line when you switch to Medicare Advantage during an open enrollment period. You have 1 year from the day that you enroll to the day that it renews to decide if you like it. If you decide that you do not like Medicare Advantage, you can go back to traditional Medicare within that year without any medical underwriting. So like we talked about during Frank's segment, you would have a guarantee issue back into traditional Medicare. You'll have to pay the premium at your attained age, which means, let's say, for example, that you were enrolled in traditional Medicare for 5 years, so you are 70 years old, and during open enrollment, you decided to switch over to Medicare Advantage. So now you're in your 70th year, and you don't like it. You just want to go back to what you had. Your premium is going to be based on 70 years old. It's not going to be the exact premium that you left. So this is something to consider, but it's not a barrier to getting back into your policy. It just means that, like that Domino's commercial, pay a different price on Tuesday than on Wednesday or whatever. So you might be paying a little bit more for the same thing if you decide to go back to your traditional policy. If you exceed 1 year on Medicare Advantage, be it your first year or any other year that you switched over during open enrollment, you will have to go through medical underwriting in order to get back into a supplement or in order to take a supplement for the first time. So what this means is it is not as difficult as a life insurance policy and nearly not as difficult as a long-term care policy. There aren't any parameds, meaning no nurses coming to your house. You don't have to have blood pressure checks or blood tests, but you will have to fill out a medical questionnaire that asks you a lot of scary questions about diseases you probably aren't familiar with. They'll also request documentation from your physicians to verify that information and see what your past history is. And the insurance company gets to make the decision if they take you or not. This is a yes or no, so that means you're not going to have a different premium than what was quoted to you. However, the insurance company is entitled to deny you coverage. This does not mean that you are without coverage. It just means that you're stuck on the Medicare Advantage side of things. I will say that if you work with a professional in determining what policy works best for you, that usually we do not see people needing or wanting to switch back and forth. If you are sure that you can see all the physicians that you normally see, if you're comfortable with the prices that you're paying, if you know what those prices are when you're going to the doctor or you're filling your prescriptions and where you can fill them and so on, most people feel very comfortable with the policy that they've elected and don't feel like switching around is a necessity. In fact, in most cases, I usually advise against it unless there is a specific reason. So, for example, if you're an individual, you've been waiting to have a knee replacement surgery or another major, not necessarily elective, but a major surgery after you retire and when you've gone on to Medicare, that might require a lot of usage. You're not ill, you just need a little bit of extra help during this time. For example, with a knee replacement, you have the initial visits, you have the scans, you have the procedure itself, you have follow-up visits, you have rehab. That's a lot of usage of the policy. You might think that a traditional Medicare policy is going to help cover those expenses for you because you know you're capped out at whatever the premium happens to be. Then you might say, well, that was my only issue, and I'm normally a relatively easy person in terms of usage. I see the doctor a couple of times a year, like Jim from our health insurance segment earlier this hour. You might say it's time to switch over to Medicare Advantage, and that's definitely something that we can assist with, that other professionals that work with both Medicare Advantage and Medicare supplements can assist with too. But usually what our primary goal is to find you coverage that fits you, that you're comfortable with, and that you can stay with for the long term.
Well, honey, that was That was a fabulous answer.
Well, thank you.
Really
made up for your
complete.
rude commentary on the beginning of the hour.
Well, we're gonna have to still get a little more pep in that promo. So I'm not changing my mind on that.
My
but
goodness.
I will say that we're curling up on 3/4 of the hour. Let's take our last break of this hour. When we come back, we'll have about 12 minutes to talk about our rock stars of the week, and more importantly, answer the questions you might have here at 314-931-5877, star 5877 for your cell phones, or the burning hot text line 84126. I'm Jeff Lapidus, the retirement coach.
I'm Aaron Lapidus, the retirement coach.
We'll be right back.
Catch your St. Louis ambush at the Family Arena Friday the 14th at 7:35 p.m. against the Kansas City Comets, and Sunday the 16th at 3:05 p.m. they battle the Chihuahua Savage. Make plans for a weekend of fun. Tickets available at the arena box office or at Ticketmaster.com.
Vacation, our most valuable time. As time goes by and we look back, it's the vacation adventures that bring family memories into common focus. And what better way to create those memories than to experience the real America in an RV? It's the journey, not the destination, that brings the family together. Hello, I'm Russ Patton. For over 50 years, Byerly has been outfitting families for RV travel. From camping trailers to motorhomes, Byerly in Eureka is the place to come. Acres of RVs, the area's largest parts store, and service bays that reach to the sky. Byerly promises the highest value for the lowest price.
For the rest of your life, Byerly Trailers. For the rest of your life, Byerly Trailers. Rediscover your family, show them you care. For the rest of your life, you gotta be there.
Byerly, just 15 minutes west of I-270 on I-44 in Eureka.
Hey St. Louis, it's Dr. Kim Simons, owner of Baldwin Dental Care, and we would like to wish you a Happy New Year. Dr. Rachel and I would like to thank you for being a part of our BDC family.
We look forward to giving you a 5-star dental experience in 2022 and cannot wait to see you at our open house Botox night on February 16th from 6 to 7:30 p.m., where we can eat, drink, and discuss facial and cosmetic goals for the new year.
For more information, visit our website at baldwindentalcare.com. That's BALLWIN dentalcare.com. From our family to yours,
Happy New Year!
New resolutions for 2022. For you, it might be shedding some unwanted pounds or saving more money. For the Big 550 KTRS, it's continuing to be the platinum standard for talk radio in St. Louis, keeping you informed with ABC News and entertained with shows hosted by the most experienced and recognizable personalities in St. Louis. 2022 marks the beginning of a new you, and for us, the next 25 years of being live and local. We are KTRS, the talk of St. Louis.
If you're turning 65 this year, you face one of the most critical choices for your retirement game plan: enrolling in Medicare Part B and choosing your Medicare supplement. I will help you safely navigate this process and find the health insurance plan that best works with your new Medicare coverage. Getting started is easy. Call me at 314-863-0008, 314-863-0008 to arrange for a free health insurance coaching session, or email me at aaron@jblfinancial.com.
Now is when Coventry turns confusion into clarity. Coventry Healthcare has got a simple approach to care. By listening to their members, Coventry can make plans that work harder for you and your budget. The result? They offer great service and clear costs. If you're looking for a plan that's more about you, give them a call at 1-855-338-9551, 8 a.m. to 8 p.m. That's 1-855-338-9551. Now is the time to call Coventry Healthcare.
This is Aaron Lapidus, the retirement coach. Wouldn't it be great to have a game plan, a real strategy, so that no matter what was going on in the stock market, the economy, or the world, you could be confident about your retirement? Wouldn't that be great? If you're within 5 years of retirement, call me today at 314-863-0008. That's 314-863-0008. Or send me an email at aaron@jblfinancial.com to arrange your free coaching session. Let's get started on your retirement game plan today.
Now back to Straight Talk and Retirement on the Big 550 KTRS. Here's Jeff and Aaron Lapidus.
That's right. We're back here on the Big 550, KTRS, Talk Radio St. Louis. I'm Jeff Lapidus, the retirement coach.
I'm Aaron Lapidus, the retirement coach.
You know, before we start our last 10 minutes of the show, I want to thank everybody for participating and making this our first 2-hour show so much fun. Feels like the time's just flying by, isn't it?
It really has, and we have more participation because we've got another text question.
Well, let's go for it.
Can you talk about getting into rehab if you're not in the hospital for 3 nights? If you're on an Advantage plan, I understand if you are on a supplement, you do not need the 3 nights in the hospital. True or false? Well, great news. This is false. So the rule that Medicare states that you need to have spent 3 nights in the hospital in order for your rehab, inpatient rehab, to be covered is actually a Medicare rule. So essentially, Medicare sets out all the rules and regulations of what is to be covered, how it's to be covered, when it can be covered, and the supplement companies and the Medicare Advantage plans have to follow all of those rules. So in this particular instance, if you are an individual that spent the night in the hospital and you need to go to rehab, if you have a supplement or a Medicare Advantage plan, if you have not met the Medicare requirement of 3 nights in the hospital, then your supplement nor your Medicare Advantage plan will cover it. Now, in some instances, the Medicare Advantage plans will actually offer you more benefits than what Medicare or a supplement will offer you. For example, many people have heard about observation versus admittance to the hospital. Many of the Medicare Advantage plans, specifically the Aetna policies now, incorporate a per dollar per day benefit available to you if you are under observation in the hospital, because unfortunately Medicare does not cover observation in the hospital. So if you happen to have a supplement, that would not be covered the same way as it would be under a Medicare Advantage plan. So both the supplement and Medicare Advantage plan have to cover at least as well as what Medicare lays out for them to cover. All of their rules emanate back from Medicare's rules, which are set by the government.
Good question, and obviously a nice succinct answer. You're obviously your mother's child, so I appreciate that.
You know, and anyone else that would like a nice succinct answer, just like my mother. 84126 on the text line. We still have at least 9 minutes left to go.
There we go, and obviously 931-5877 if you'd like to talk to us live. While we are waiting for your calls, I do want to talk about our rock stars of the week. Sam is 64 and his wife Judy is 62. They're both eligible for pensions from their work, and they're also going to be receiving, if they do terminate their employment, 1 year of severance pay plus their accumulation vacations. They don't have a mortgage, which is really fun. That basically tells us they could be rock stars. And they have no significant credit card or student loan debt obligations.
Which tells us they've most likely been living well within their means.
Love to be them. I'm sure somebody's thinking out there. In our discussions, we found that their goal of income every month to cover their expenses, their net after tax amount, was $4,500. Naturally, what we do is we increase that by 20% so that we're looking at what their gross cash flow need would be every month, which is $5,400. Let's talk about their sources.
All right. So, if they decide, which of course they will, to elect the joint and 100% joint and survivor pensions, meaning if either one of them passes away, the surviving spouse will receive 100% of that pension amount. That totaled $2,600.
Right. Sam's Social Security normal retirement age benefit would be $2,900, and Judy, she had worked a little bit, had a lower income, not worked as long, would be $1,450, assuming that she waited until Sam was receiving his normal retirement benefit, and she actually was at normal retirement age.
Right. So that means that's probably closer to 5 years out for Judy, based on the fact that she's 62.
So their sources of income would be $6,950 a month, which means that they've got some extra money if they wait and take their pension and take their Social Security.
Wait, so now they're going to be, not only are they rock stars going into retirement, but once all of the faucets are turned on and they've elected to wait until normal retirement age, they're actually going to be making money in retirement?
Well, they got a very big woohoo, on that one.
Right?
And you're right. They do have sufficient liquid savings plus their severance to cover the 2-year gap before Social Security normal retirement benefits begin. And not everybody's in this position, but for them, this is kind of a boon because that gave them the flexibility to decide, do they take it now or do they wait? That also gave them the flexibility to say, hey, if I want to continue to work part-time because I haven't hit my normal Social Security retirement age, they could do so without having to worry about the Social Security take-back, right?
That is correct.
One of the options that they did have available to them was in lieu of taking that $2,600 a month 100% joint survivor pension benefit, they could take a $540,000 lump sum. That's a question. Second one is we know that their 401k balances ran about $1.1 million. So
wow,
these folks, they have all the characteristics of rock stars, right?
Yes, they do.
No mortgage obligations, no significant credit card debt. They've got high levels of current income, and they also have accumulated a fair amount of retirement income assets. Their big questions were, number one, do I take a pension or Social Security, and should I wait and put my Social Security benefits off even as far as age 70? What do you think, babe?
So I think the first question is great, and we even had a caller call in about this. And our first topic in our elusive new first hour of the show really focused on pension versus lump sum as well. What are the key decision points to make that you might have in making this decision? I would say that the first the first thing to consider is, what is that payout rate available to you? The easiest way to calculate that is to take the monthly pension payout by 12 months, getting your annualized amount, and dividing it by the lump sum that you're being offered. You want to compare that to what current interest rates would be offering you. The second thing... Yeah. Oh, go ahead.
And we like to think that number is probably somewhere, it ought to be at least 6%.
So in Sam's case, he was right at 5.7%. So, maybe a little bit low, maybe right where he wants it. That doesn't seem to be a deciding factor in this moment. The second thing to consider would be, do you want the opportunity to pass these assets on to your beneficiaries? If you elect the pension, then if you elect 100% to the survivor, then your spouse will be receiving that continuation of your pension benefit. But after your spouse passes away, that money is no longer part of your estate. So would you like the opportunity to take that lump sum, live off of the interest and the earnings of the lump sum potentially, and then have the opportunity to pass that balance on to your beneficiaries?
Yeah, babe, that's really big. And I would say the other factor here is, do they really want to continue to retain control over their taxable income? Once they decide to turn on that pension faucet and then also turn on the Social Security faucets, those incomes are fixed. They can't be skipped. They can't be reduced. They're there to go. And we know that if they do even wait till normal retirement, not age 70, but normal retirement, they're still going to have excess money every month of about $1,550 a month. So if they want to pass this on to the kids, and we haven't really, again, taken into consideration the fact that they've got this $1 million plus of retirement assets, it probably makes sense for them to seriously consider the lump sum benefit.
That's right, because they'll have the opportunity to control their income, meaning that $18,000 a year of excess they won't have to pay taxes on because they simply won't take it out of their newly created IRA accounts, where just like the 401k balance that can be moved from a 401k to an IRA, the lump sum can also be moved directly into an IRA. So you don't pay taxes at the point of the transfer. You only pay as you start to distribute money from your IRA account.
And I would say in all sincerity that this is the fun part of retirement planning. Sam and Judy have a lot of options, as many of you do. And the question that usually comes to most people's mind, and they usually bring out to us, is, am I making the right decision? The bottom line is that the right decision is really based on you, how you're feeling about certainty of cash flow, how you feel about passing on these assets to your children. And all these things are really best uncovered, I think, with a professional during a coaching session. So it's easy to do. Give us a call, 314-863-0008, or send us an email, Jeff or Aaron at jblfinancial.com.
The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and JBL Financial Services, Inc. are separate entities from LPL Financial.
Be listening next week at 9 for more Straight Talk on Retirement with your retirement coaches, Jeff and Aaron Lapidus, on the Big 550 KTRS.